Welcome back to our Samvat special Market Masters. I have now with me Vetri Subramaniam, the Chief Investment Officer at UTI Asset Management Company. Vetri, thank you very much indeed for joining us. Season's greetings from all of us at CNBC-TV18 to you and yours. Well, let me start with a heavy question. I did a Samvat with with economists. And the general feeling is that the GDP growth for FY24 is going to be south of 6%. I got an average of 5.7, even if the RBI is standing at 6.5. So what is your earnings picture for this year and next?
Sure. First of all, Lata, season's greetings to you and the entire CNBC TV18 family and all the viewers. Wishing all of you a very happy Diwali and, a wonderful year ahead. Well, unfortunately, you started on the note of cuts. And yes, GDP growth estimates are getting revised downwards. Most of the estimates we are seeing for 24 are coming in lower than 6%. If we look at the Bloomberg consensus earnings forecast, both for FY23, which is the year ended March 23 and 24 as well, the trajectory has been one of a gentle decline over the last 2 to 3 months. So we've now got FY23 consensus on Bloomberg at about 10 or 11% earnings growth and 24 at about 15-16% earnings growth. But the trajectory is continuously coming lower. And when we look at a lot of the global commentary, what we are seeing is that the probability of a recession in the US certainly rising. We already know that Europe has literally a severe crisis brewing. China has its own problems. And therefore, the whole global picture is looking slightly subdued. Now, funnily enough, global earnings growth and particularly US earnings growth haven't really been cut too much for 23. And given the rising probability of a recession or some sort of a setback in their economy, you should start to see earnings cuts there. And I think some of that will translate into the Indian earnings numbers as well. So there is certainly some downdraft on earnings forecasts at this point of time.
Okay. Well, be that as it may, this year we have been outperformers as an index, Nifty, especially in rupee terms. So does that continue? I only mean relative outperformance of the Indian market, simply because we are slightly less connected to global growth. Rival economies like Korea and all, logically should fall more if the US is going to be downgraded in its earnings.
You're absolutely right, Lata. We discussed this the last time we spoke as well. We have been outperforming. So there are two ways of looking at this. You could look at the last 1 year of the market return and say, oh, we are down 4 or 5%. Or you could look at how all the other markets have done, which are down 20-30%, and then realize how much better off you are in a relative sense. Obviously, as people have said, you can't eat a relative outperformance. You can only eat absolute performance. So yes, that is in a sense perhaps slightly disappointing, but yes, there is significant outperformance. And I think it's important to just remember this, right? And, in fact, I had some people call me after our last conversation and said, are you talking about decoupling or are you talking about outperformance? And we need to be very clear. We're only talking outperformance. You can't really decouple because, 21% of your GDP is exports of goods and services. That's going to be the area which will first get hit if global growth slows down. But there will be second level effect on other sectors and third level effects, right? If IT salaries have gone up tremendously over the last 1 year, it's obviously created a bit of a spending boom in various areas. You could argue that if the IT sector salaries start to cool off, it will show up at some level in the demand for real estate in Bangalore or cars in Bangalore. I'm just simplifying the picture. So there will be first order impacts, there'll be second order impacts, and there will be downstream impacts. So we should expect that there will be some of that. Now, why are we outperforming? I think, again, it's interesting. You mentioned the word local currency. Now, you can be despondent about the Indian currency being down 7% 7% for the year. But when you look at a relative stacking of EMs, we are actually doing very well, right? I mean, in fact, even China's currency is doing worse than us year to date at this point of time. So, you know, we are, as Paul McCulley once famously said, today India can claim to be the cleanest dirty shirt in the laundry. Everybody is in the laundry because your macro variables have been thrown out of gear over the last 2 to 3 years. But among those shirts which are in the laundry and which need cleaning, yours is relatively cleaner.
Okay, that's really good to hear. But can you just parse the global environment? Do you expect some kind of, you know, waterfall kind of drops? The UK gilts gave us a heart attack. Or do you think it will be more, you know, stable or maybe gentle decline? Just parse, and how do you see the year ahead in terms of stock index?
Sure. So, you know, first of all, I should just point out that we don't really forecast where markets go. I learned very early in my career that it's impossible to forecast where the market will go. I'm generally optimistic about the prospects for growth in India over the longer term. And that's the reason to look at equity, not because, you know, we think it'll do particularly great over the next 6 months or 1 year or any such thing. Second point I should make is that valuations, which were very rich a year ago, now are trading somewhere between the long-term average and +1 standard deviation, almost at the halfway point between those two you know, lines on the chart. And to that extent, there is some broad comfort that we can take that we are in the comfort zone as far as valuations are concerned. Stagger your investments because we are still dealing with an environment where there is high level of uncertainty about various global events, though one could argue that is always the case. Now, when we parse this global environment, I just make 2 points over here, Lata. I think, you know, late last year, we went from the point of saying inflation is transient to saying, yes, we need to start to fight inflation. We've seen global central banks, particularly in the West, come out all guns blazing. And you could argue that for particularly the US Federal Reserve, you know, a mild recession may actually be the cure or the medicine that they need to cure the underlying ill, which is actually inflation. So they don't mind a recession happening, is the way I would parse it, even though they may not say that explicitly. But I think what's happened is that because of this dramatic increase in rates, you've now moved to a point where it's no longer just about how will the economy handle these higher rates. It's moved to the point where you start to worry about fragilities in financial markets, right? People have been borrowing money right, left, and center over the last decade. This has been the decade of easy money. And look at the surge in rates which has happened in the developed world in dollar borrowing rates, both at the short term, medium term, and long term. Now we are in a situation where we don't know how many people can actually still access liquidity when they have to roll over their debt. Whether it makes sense for them to even try to borrow at the current rates, which are significantly higher than the rates they possibly borrowed at 1, 2, 3 years ago. And therefore, you're in an environment where financial shocks is something that we need to worry about a lot more. So I think it's not just about the economy, but I do worry about the possibility of financial shocks emerging as we saw in the example that you made in you know, UK, where it happened in the gilt market. And if we start to see any kind of shocks like this in the US, then I think it will start to transmit a lot more globally. Interestingly, in the US market, there is already enough data that this whole LBOs, private equity funds, buying out companies is coming to a grinding halt because nobody is able to raise credit anymore to do those big LBO transactions. So financial market stability and liquidity are perhaps the watch points, not just how much will growth slow down.
Yeah, I agree. We got a trailer from the UK, but the way in which the BOE and the UK government stepped in, government no less eating humble pie, now the mood among the markets is a bit sanguine that, you know, the Fed put exists, the Central Bank put exists. Anyway, we never know how long. Let me come to, give you a half volley, as it were, something up your alley. Interest rates. Now I can get 7.5% on the 10-year Government of India bond. Yes, deposit rates have not risen, but that should follow, isn't it? In the US, again, the same thing. But 2-year is giving you 4.57. Why would you put your head into equities? Do you see a flows issue primarily for the domestic market, which you handle?
Sure. We can look at this 2-3 ways, Lata. I think when you've got short-term yields in the US at 4%, long-term yields, above 4% as well, it's a magnet for capital to say, hey, if we can get this in risk-free bonds in the US, why go elsewhere? And I think there's also a deleveraging that's happening across the world, and that's contributing to dollar strength, because remember, that's the currency in which a lot of global borrowing happens. So when rates spike up like this, people may choose not to roll over their debt, unwind their positions, send capital back from where you borrowed it, and that partly accounts for the strength of the dollar. Now, in India, it's very interesting. When I talk to my fixed income team, we know that we can create portfolios in reasonably, let's say a government PSU type portfolio with a 3.5-year Macaulay duration, which you could have portfolio yields in the range of 7.20, 7.5%. And therefore, when we run any model to look at equity market valuation relative to bond valuation, actually, increasingly there is pressure simply because the bond valuations are starting to look more favorable relating to equity at this point of time. However, when I talk to retail investors, they're not looking at the kind of portfolio that we can create at 720, 750. They're looking at what they're getting on the 1-year fixed deposit. And if you look at leading banks in India, the fixed deposit rates are just a shade above 5%. Even if you go to a 3-year deposit with most large Indian banks, they're at maybe 570, 580. Whereas in the bond market, you could actually create a portfolio with a 7.5% yield today with reasonably good credit characteristics. So to my mind, as of now, in our models, bonds are starting to look quite attractive. But I think in retail sentiment, they haven't seen it because the FD rates have not moved up. Liquidity is very tight. As you know, CD issuance has gone through the roof over the last 1 year. So what banks are doing, they are preferring to raise rates in the certificate of deposit market rather than raise the FD rate. Exactly. And when you start to see the FD rates go up is when I think retail will also start having to ask that question that, what's the attractiveness of that FD rate to me? And I think once it goes north of 7.5% on 1 year, 3-year range, that will start to create a little bit of pressure on money flows choosing to go over there.
Time permitting, I will come back to this. Our viewers are going to beat me if I don't ask you sectors first. Banks were such a favorite this year. Is it still going to be economy facing? What sectors would you prefer now?
Sure. So I think, Lata, long time back when we spoke a year ago, we spoke a lot about the auto sector where we said, look, everything that's gone wrong for them has gone wrong. They have a supply problem. They had a demand problem for 3 years. But how many sectors in India do you know where volume is significantly running below peak volumes of 2018? We've clearly seen a sharp V come through over there. We've seen the auto sector do well. We still think there is room to go on that, though the valuation comfort is not as high as it used to be a year ago. Banks, and particularly I would say, the consolidated set of maybe 5 to 8 large lending institutions in India, that's an area we still like because we think, India's structural credit growth story still looks very strong, and there's a significant degree of market share gains that these, top 6-7 institutions are making. So we still like that area as well. And I'd say one area which is more sort of contrarian, bad news, ignored, is the pharmaceutical and healthcare sector. Honestly, that was something we liked even a year ago. It hasn't done anything, but from a contrarian point of view, therefore, that's an area that we still think looks reasonably attractive, and we'd like to position over there for the future. Okay,
that's very useful advice, not just cakes and finance, but you're also giving us a bit of medicine for the year ahead. Thank you very much, Vetri, for joining us, and have a great Samvat ahead. We wrap up on this edition of Samvat Market Masters. Chartbusters will take the action forward.